There have been a ton of stories out there that inventory is significantly increasing, price cuts are at multi-year highs, and home values are declining. This is very misleading. Active inventory has risen 6.7% in June and is up 37% from last year, but it's from very low numbers and 1/3 of the increase from 2 states alone, Florida and Texas. Everywhere else, inventory is tight. Inventory in the Northeast is 57% below pre-pandemic levels, while the Midwest is 49% below pre-pandemic levels. Now on prices, the media has been citing that median home prices are down in the South and moderately everywhere else. But as always, this is skewed by the mix of sales. If you look at the median price per square foot, which accounts for smaller, lower price homes selling for more than bigger, higher price homes, prices are rising. The Chicagoland area is still under 2 months supply of homes, which is way below the 4.6 month supply of the normal market, continuing to support values for the foreseeable future in the area. Now, as for mortgages and inflation, last week the Bureau of Labor Statistics reported that there were 206,000 jobs created in June, which was pretty close to the estimates of 190 to 200,000. There were big negative revisions to the previous 2 months, totaling 111,000, and last month's reading of 272,000 revised lower to 218,000. April was revised lower from 165 to 108,000, which was a completely different story. Remember, May will get revised once more and will likely be even lower. Now, the unemployment rate went from 4% to 4.1%, the highest level since November of 2021. This triggers a recession signal called the Shum Rule. Now, Fed Chair Jerome Powell testified before Senate yesterday, and here are some of the highlights. More good data would strengthen our confidence that inflation is moving substantially towards 2%. Elevated inflation is not the only risk we face. The job market has cooled considerably, and if the labor market weakens unexpectedly, it could be a great case for cuts in interest rates. Cutting interest rates too late or too little could weaken economic activity and employment. The economic growth has been moderate after a strong expansion in the second half of last year. Now, in our opinion, Powell sounded a touch more dovish and wants to cut rates in September. The CPI report comes out tomorrow, and it could be a big market mover. We will update you with any important movements. Interest rates fell below 7% on average from last week to this week, which is moving in the right direction. Please keep in mind, we always have this temporary buy-down program that could help lower your interest rate temporarily for the first couple years. And with the housing market softening just a little bit, you could have some room to negotiate with sellers to be able to get that lower rate temporarily. So call me if you have any questions or DM me. I'm happy to help and make it a great one.